Okay. Hello, everybody. Good morning, good afternoon, good evening, depending on where you are. My name is Kara. I head up marketing for Hustle Fund. This is Elizabeth. You know her, needs no introduction, but she's a GP at Hustle Fund for that introduction. We're going to get started here in a second. We love to know where people are coming in from. We often have a global audience here. Do you mind just dropping where you're dialing in from in the chat? And we will get started. I'm just going to give people a moment to log in.
Yeah, that's always fun.
Nice.
And this session will be pretty interactive. So, if you have questions, definitely don't be shy.
Absolutely. And in fact, you should see towards the bottom of your screen, depending on how your Zoom is set up, a little Q&A box. And so while the chat will be going throughout the whole presentation, Q&A is a great spot to drop your questions. It's just a lot easier for us to track. They don't slip through the cracks as much. So we're going to get started. Today, we're talking about portfolio construction, how to think about how often to invest, what size checks to invest, various industries to invest in, such that you're building a portfolio that will hopefully yield the highest returns, or at least the highest chance of returns. This was something Elizabeth has talked to me about on our team retreats or over candy at various times in our relationship. And I think it's fascinating, and I think you will find it fascinating as well. So Elizabeth, do you want to kick us off?
Yeah, we'll go ahead and we'll get started. So just quick intro on myself. As Kara kind of mentioned, in my day job these days, I'm a VC at Hustle Fund. I started this firm with two friends of mine, now going on 6 years ago. And we have invested in over 400 companies at Hustle Fund. We invest at the earliest stages, what we call pre-seed, so generally pre-revenue, pre much of anything. And we invest globally. And then prior to that, I was an entrepreneur for a very long time. I started my last company during the last recession in late 2008, early 2009. I have wonderful timing, and I couldn't raise money for a very long time, but somehow through just learning through a lot of hard lessons along the way over the next several years, grew that ad company. That company was acquired in 2014. And that's actually how I started learning about investing in the first place. I've done a lot of angel investing, and I also previously ran the 500 Startups Accelerator program, where I was there for almost 3 years and led several batches. So all in all, across my angel portfolio, 500 startups, and Hustle Fund, I've invested in about 700 companies. So I have a lot of thoughts on investing in companies, for better or for worse. But I think the main one is, people often ask, like, oh, how do you pick companies? And I think my general response is, well, honestly, you don't really know what's going to happen, especially when you're investing so early where we invest. And I think the mistake that I see a lot of new investors make is they just get so excited about a company. I think truthfully, most of the time, I'm not that excited, even in the companies that I invest in these days, because I just know that the path going forward is going to be so hard and so long, even if you're an amazing founder, or even if it's an amazing opportunity set, right? So just so much can happen along the way. There's a lot of luck involved, et cetera, and you just don't really know. And as such, actually, my general perspective on this is investing is less about picking companies, but rather picking portfolios. So that's why we're doing this session today, because I truly believe that portfolio construction is so important. I think deal flow is probably number one, but portfolio construction is a pretty close number two. I think picking companies or trying to pick the winner at pre-seed or seed is just too hard. There are too many pivots that can happen and too many pitfalls that can happen along the way. I'll pause there. Kara, any thoughts or reactions before we kind of dive into the meat of this?
Well, that last thing you said about, there's a lot of pitfalls in early stage startups. There's a lot of pivots that can happen. Feels a little scary when you say that, if I'm honest. I asked them, why did you choose this stage? Why not go with something a little bit later? It's perhaps a higher valuations, but it's perhaps less of a risky bet.
Yeah, so actually, this is a great question, and this is directly related to portfolio construction. So I think certainly if you're investing in, let's call it pre-IPO stage, a lot of the risk is off the table. You know, hopefully that the business is working. You can generally model out their growth rate. You can see how profitability is going or what it's working towards, et cetera. Like, I have no finance background, but this is where you bring in your finance team, crunch all the numbers in a spreadsheet, and then you're basically trying to figure out at that point, like, what is the right valuation, you know, and obviously there's no right or wrong answers. There's still quite a range there, but what sort of valuation are you willing to give this company if you're willing to invest? It's less about, will this company die tomorrow? But much more about, you know, what do I think the return could be on at that late stage? And so as such, portfolio construction at that stage, I mean, frankly speaking, you look at things deal by deal and it's probably okay. Like, it's less dire to have, you know, 50 to 100 companies in your portfolio at that point. Like, it actually really doesn't matter. But at the early stages where we are, where the companies are even pre-revenue, I think it is so important to have portfolio construction to mitigate your downside risk. And so to this point, about why we pick this stage and kind of what portfolio we're looking at, I think the late stages are, well, one, incredibly competitive. To get into the best deals, you have to have sharp elbows with everybody else, including some of the major firms we all know about. I don't need to name names, because at that point, it's pretty clear this company is going places. So that company gets to pick what investor to work with, but they're not really going to pick a new investor like myself. Not to mention that I have zero late stage experience. I never grew my own startup to that late stage, and nor do I come from a background of investing in late stage companies. So from a founder firm fit, that's like not a great fit for me. But I think even beyond that, even if I did have that background, you are in the fray with everyone else, like trying to battle it out to win the deal. At the earliest stages where I play, and often prospective LPs ask me this, like, how do you win deals? You know, I think there are still some companies at pre-seed where they get oversubscribed or whatever, and you're trying to get allocation. But I would say that even in some of the deals that end up becoming hot, there's a good period of time of at least a month or two where they're not hot, because honestly, nobody knows that this thing is going to work. And so I think at pre-seed, it's less about, oh, can I get into this deal, and more about, all right, now which deals am I actually doing? And this is where portfolio construction comes in, where now I have to think carefully. If more than half of my companies are going to fail, and I fully expect that in my portfolio, now how am I going to construct it? And this leads me to sort of the number one mistake that I see most new angels make, which is, again, going back to this point of, oh my gosh, I'm so excited, this is the best company I've ever seen, I'm going to plunk all of my money in here. Actually, a friend of mine on Twitter tweeted this morning that actually that's what he did with his angel budget. He took his whole year of angel budget and plunked it in the very first deal that he liked, which was a huge mistake. I don't know how that company ended up doing, but I would say in general, that's a huge mistake. And if it worked out, great that he got lucky. But in general, that's not how I would play the odds.
Okay, so how, I mean, it's clear that this is an important topic to you. I would like to dive into how you would play the odds, but I also just want to briefly talk about what you mentioned a few moments ago, which is that the two most important things that you mentioned for early stage investors is deal flow and portfolio construction. Why is portfolio construction so important?
Well, to this point that you can't predict, I think you just have to actually acknowledge that you're going to have a lot of failures in your portfolio. And psychologically, this stage may not be right for everyone. You know, there are a lot of people who don't have that risk tolerance, even if the portfolio works out well. Just knowing that half your or more than half your portfolio may fold, like some people just emotionally may not be interested in that, and that's okay. Like, I don't think we all need to do everything, right? So I think that's something that's really important if you're thinking about going into early stage investing. Like, you have to be very comfortable with over half of your portfolio failing. And on top of that, the ones who fail tend to fail earlier. Like, the winners are the ones who continue on by definition, right? And they continue on to do well, but their doing well will take many years. It could even take a decade or more. I think Dropbox went IPO in 15 years from seed to IPO. So And that's a great case scenario. So I think you're going to be waiting a long time for your winners to really mature if you have one. But in the meantime, in the first 3 years, it's going to feel horrible because all of your companies are seemingly failing left and right, right? So that's the kind of psychology you have to battle in this stage of pre-seed to, I would even say, Series A.
Okay, so then why is deal flow the most important then?
Well, I think it is important at any stage to have great deal flow because, obviously, since this is a power law game, like the winners will more than make up for your losers. You want to be able to capture that, even if you have, let's say, a large portfolio of, hey, I'm picking 200 companies. You want to be able to capture at least one, if not many, of those huge, huge companies. And nobody knows who that ends up being. But I think generally speaking, if you have great deal flow, then that increases your odds of, getting one of those. So I think one of the mistakes I see people making as an early stage investors, is they think about the world linearly, where it's like, all right, I don't understand if I am investing in, let's say, 100 companies and half of them die, and then I have some winners, like, doesn't it net out to 1x? But the answer is no, because if you truly have one of these outlier winners, that outlier winner will more than make up for all of your losses in your portfolio, and even your mediocre companies that return more than 1x, but not tons of money. So a good example of this is Uber. If you had put in just $5,000 at the seed, and if you had held all the way to the IPO, you would have made about $25 million. So, if your personal angel portfolio is, let's just call it, I don't know, $100,000 over the next decade, 25 million against your 100,000 is like insane, right? So if you have just one of those, you don't even care if any of your other companies lost your money.
Sure, that makes sense. So, I have this whole list of questions, but I want to dive into what you said about your friend on Twitter who plunked his or her entire budget into the first deal, the first deal that person saw, or the first deal they got excited about.
I think first deal that they got excited about, but you know what? This is actually a common story. I know so many people who have done this. It's actually pretty insane. And so, what I often see is angels say, oh, okay, I'm gonna put down whatever, 25K or 50K into this company. And they do that a couple of times. And then all of a sudden they're like, well, actually, I can't afford angel investing anymore because I'm done. Like, that's all I've got. And then so angels kind of sit out for the next several years while they're, building up their reserves and getting bonuses at work again. But I think actually the better way to start, and again, this is just to start, you can change your strategy along the way. But if you're completely new to investing, I would highly recommend a very diversified, a large portfolio construction. So now we're starting to get into the meat of it, and eventually we'll go to the whiteboard. But if you are new, I generally recommend to new angel investors to try to aim to build a portfolio of 50 to 100 companies. And it's not all this year. You don't have to invest all this year, but over the next several years, call it 5 to 10 years. So that can actually be quite doable for a lot of professionals, even if you're not super rich, because what I'm saying then is, let's say that you're investing anywhere between 1K and 5K checks in each company. If you have, let's say, 50 or 100 companies at 1K, that's 50K to 100K over the next decade. So that comes out to, $5,000, $10,000 a year. And if you're, let's say, a professional of sorts, that is fairly doable.
Yes, that does feel very doable. Certainly, I feel like based on I'm not even an institutional investor, right? But I get people emailing me on LinkedIn and Twitter all the time. Here's my startup, like, will you invest? So pretty easy to see 50 to 100 startups in a year, let alone 5 to 10 in 1 year. But I don't usually want to invest right in like just any, you don't want to invest in any company, you want to invest in the right company. So how many deals do I need to evaluate in a given year to presumably invest in 5 to 10 of the most promising?
Yeah, well, I can tell you at Hustle Fund, in a given month, we see about 1,000 companies, and we end up investing in, on average, I would say about 7 companies per month. So that gives you a bit of sense of the comps, like where it's less than 1%. So now, this session's not on deal flow, but I do want to touch on this really quickly. It's like, how am I honestly going to see that much when this is not even my day job and I'm an angel. Or maybe you are starting a new fund, but it's so busy to start a new fund. Like, how am I going to see this stuff? And I think a good place to get started if you're new and you don't have network, you don't have brand, like nobody has heard of your new emerging fund, nobody has heard of you. There are some tips and tricks I've learned from other people along the way. So for example, one of our Angel Squad leads, Andy Lewis Charles, he started with Generalist. And basically anybody can sign up for just about every syndicate on Generalist. And that's just to see deal flow. So I think most of the people in this room are familiar with Generalist, but it's a platform, where people can create groups of investors to invest together. So this allows you to invest small checks. So as a starting point, if you sign up for everybody who's a syndicate on Generalist, you'll be able to see a lot of deals. And the reason it's important to see a lot of deals is ultimately investing is a comparison game. I think in isolation, every company looks great. But now if, let's say, you're looking at 100 companies, if you had to pick out like the best one or two, then all of a sudden, not everyone's going to be that top one or two, right? So that's what you're kind of looking for when I say looking for good deal flow. You're trying to see enough to be able to play this comparison game. Another source is to tag along with friends of yours who may already be angel investors. And, just basically let everyone who is an angel investor know that you are starting, out slowly with your angel investing and you would love to, tag along to meetings or, look at stuff together or whatever. That's a very common way that people learn and start to see deals as well. I think it really comes down to seeing a lot so that you can calibrate what you end up doing. I don't think you have to start actually investing right away, but I think if you do want to angel invest or start a fund, I think you should start at least looking at what is out there.
Okay, so then let's say I just started angel investing. Somebody sends me a deal that looks really interesting. I'm excited by the opportunity. Are you suggesting that like perhaps I wait and not invest actually and like maybe look at, I don't know, 10 to 50 additional deals to make sure that this actually is as good as it appears?
Yeah, I would, if I were starting angel investing today, I would probably not invest in the first thing that I saw. I suppose there's the chance that I would miss, and that's fine. And there are certainly things that I have missed on earlier in my career because I didn't feel like I knew enough to pull the trigger, and those companies went on to do incredibly well. But I think in general, that strategy is a good strategy in starting to look at companies without actually investing. Just start looking, look for a month or two or whatever, just to see, call it over 100 deals. Because again, like your hit rate is probably about 1% or thereabout. So you need to be kind of seeing batches of 100 to get a sense of, all right, I have some calibration of what good deal flow looks like. But I think even once you see good deal flow and you're ready to pull the trigger, it's like, okay, now I've seen 300 companies. I think I have a good sense of what I'm looking for. I still would employ this portfolio construction because again, even if you're picking a company where the founders are great and the opportunity seems great, there's just so much that can go wrong that, you still need a good portfolio construction. Now I'm going to get lots of pushback on this quote spray and pray portfolio construction in a second, but I do want to emphasize this is where I think new investors should start. But after you get more seasoned, you may want to change your strategy. And we can certainly talk more about that, but, or you can keep it. I think in general, there's so much data now to show that you can actually build a great portfolio, even just with the spray and pray method. And frankly speaking, the diligence and the time required is a lot less when you're risking less capital in each of these companies because you have a larger portfolio.
Mm-hmm. Do you think that the strategy that you've been discussing so far is applicable to angels, emerging funds, family offices? Like, is there any variation that you would recommend based on the type of investor you're talking to?
I think this strategy for new angels and family offices getting into it makes perfect sense. I think that for emerging fund managers, it may or may not make sense, right? Because you're going to have to sell your strategy to external investors. And I can tell you that the market in general doesn't really love this diversified spray and pray strategy, even though it does work. And the reason for that, when you think about it, is people who invest in funds, so fund of funds or pension funds or endowments or whatever, they already have a spray and pray strategy, right? They're investing in tons of funds who each invest in startups. So they already have that strategy. They don't need you to provide that strategy for them. And in general, LPs are more interested in a concentrated strategy, which is a smaller pool of startups rather than sort of this large construction.
Okay, that feels slightly ironic given that, Hustle Fund's strategy is wide, right? I don't know if I would call it spray and pray, but like, how somebody actually asked this question, Mono did. How has Hustle Fund's portfolio construction changed since starting the fund?
It hasn't. It hasn't. Well, so, okay, then the question is, if you are an emerging fund manager and you're trying to fundraise with this strategy, even though a lot of LPs don't like it, how do you then get LPs? I mean, I think then you're going to a different set of LPs. Like, we do not have a lot of institutionals in our fund, partly for this reason. But we do have a lot of angels and family offices in our fund because this is a lot of work. You're constantly looking at lots of deals, right? Like I talked about how we look at 1,000 deals a month. So you're always busy and you're always investing. And so there's never a dull moment. And I think, many people who have day jobs doing something else may feel like, well, gosh, like I don't have the time or the inclination to do any of this. So I would much rather just invest in Hustle Fund. So that's kind of our pool of folks who gravitate towards this strategy and this kind of fund. So you have to, like, if you're raising money for a fund, I think that's a totally separate topic and a totally different webinar as to how you do that and how you match your strategy with LPs. But this is one of the byproducts of your portfolio construction is your strategy and kind of sets everything else.
Okay. And if we don't think critically about portfolio construction, what horrible thing's going to happen?
Well, I mean, let's say that you have a concentrated strategy. By definition, it can work quite well. So let's say instead of investing in 50 companies, you're now investing in just 10 out of your fund or out of your budget as an angel. And, it's quite possible for all 10 to go to zero. Lots of angel investors don't make money. And in large part is because they have a concentrated portfolio. Or in the case of my friend, you put all your money on one company. Well, we all know that startups fail every day. So if you pick the wrong one, that could go poorly. On the other hand, if it goes super well, then that strategy is way better than a spray and pray strategy, right? If Uber is the only company that you picked, then great. However, portfolio construction is all about the combination of trying to capture upside, but also mitigating downside risk. So I think there is that balance around, if you're going with a concentrated strategy, you now believe that you're actually quite good at picking. And therefore you're willing to take more of that risk, that downside, incorporate that downside risk in exchange for larger returns. And somebody who has done this incredibly well actually is Chris Sacca with his former fund, Lowercase Capital. I think he only had about 10 companies in his portfolio, but 2 of them were Uber and Twitter. So, I think that fund returned something like over 200x or something ridiculous like that, right? So if it can definitely work, but there's more risk there. So that's why I don't recommend it to new folks. But if you are a seasoned investor and you feel like, okay, I'm great at picking, then by all means, like, go for that if you feel like you're willing to take that risk on.
Yep, love that. We have a lot of really good questions. Shall we take some and then maybe move to the whiteboard?
Yeah, let's do that.
Okay, cool. So this person says, would you recommend focusing in on a specific industry or vertical at the beginning as an angel to make those comparisons quicker and build your ability to pick out winners in that area?
Oh, good question. So I'm kind of 2 minds. I personally think that if you are investing really early, the generalist strategy allows you to see more. If you start going specialized, then almost by definition, you're filtering everybody else out, right? Which means less deal flow. So you have to really build a brand if you're going to be specialized. So an example of this might be Better Tomorrow Ventures. They're a great fintech pre-seed fund. They are focused on fintech and they have built their brand around fintech, and the GPs have lived, breathed, and lived and breathed fintech like their whole lives, right, with their prior company. So you have to really then attract the best deals in whatever sector you're in. I think that certainly, though, even if you are generalist, it doesn't mean you have to like do every deal, or like, well, you shouldn't do every deal, but I'm saying like there are certain categories at Hustle Fund that we just don't do, even though we are generalists. Like we don't invest in e-commerce, we don't invest in cybersecurity. Like these are things we don't know, so we just don't. We don't invest in a lot of consumer either. So you can like, I would encourage you to throw out things you're uncomfortable with. Don't feel like you need to do a deal in there. But I also think that if you're going very early, in general, you probably want to have a wider net, unless you're a well-known subject matter expert in something. Like everybody comes to you for developer tools because you're well-known in, let's say, the developer community or something like that.
Yeah, makes sense. Somebody on this topic has asked, how do you avoid conflict of interest when you have multiple investments in the same sector?
Yeah, it's a great question. I mean, I think just being, so I'm of two minds. Again, because I used to be at 500 startups where it was even more high frequency investing, and YC is also very high frequency investing. You'll often find in accelerator portfolios that there are conflicting companies. And I think, it all comes down to the messaging and what you end up doing. You're not going to be taking a board seat on any of these companies with this strategy. You will have no time to take a board seat, even if you wanted to, frankly speaking. And the other thing is you can just, tell everybody, hey, we don't share information across our companies. So in the event that, let's say, a company pivots into the space of another company that you have in your portfolio, which happens all the time. Like we have some conflicts in our portfolio because of that. We generally try to avoid conflicts as much as we can, but it ends up happening, and it will happen. So I think in those cases, it's just, we're especially sensitive where, okay, we're just not going to share. In general, we don't share information across our portfolio companies. But like, especially in those cases, like it's just, there's not even a mention of those companies.
What about for follow-on checks? So, Mark has a question about strategy just in general, right? Early checks give you future access and inside information, how to reserve for these follow-on opportunities. But also I would add on to that, like how to think about follow-on checks if with companies in the same sector.
Yeah, so my general belief around follow-on is that I think a lot of investors in VC will disagree with me. Like everybody has an allocation, a very specific allocation for follow-on. We do not at Hustle Fund, like we don't say this amount is set aside for follow-on. The way that we think about follow-on checks is, do we think that the follow-on opportunity is the best opportunity we could be taking? So I'll give you an example. Let's say that we have $100,000 and we write, I don't know, well, let's make the math easy, 10K checks. And we can invest 10K checks into, let's say, a pre-seed company. Or just because of how the pro rata shakes out and all that, we could invest one $100,000 check as a follow-on investment into one of our companies that we know more information about, it's at a higher valuation, etc. Which is the better opportunity set? Like taking the 100K to plunk into that one company, or taking the 100K to plunk into 10 more new positions? In general, just kind of in looking at our portfolio, most of the time it is actually better to take the 100K and plunk it into 10 new companies. However, there are certainly exceptions where it's like, oh my gosh, this thing is just growing like crazy and it's an amazing business. And if that is the case, you should take your 100K and plunk it in there. So again, it's like not a hard and fast rule. I think the other thing that complicates things is timing. Like you don't know when these opportunities are kind of come to you. Like the follow-on opportunity, it's coming to you now, but then you have these 10 other great companies that are coming to you now. Or vice versa, like you have this follow-on opportunity, but actually the new deal flow you're seeing is terrible. But you need to invest the 100K now. And this is especially more so for funds who have a timeline on which you need to invest. Like for us, every fund that we raise, we can only invest in new positions for the first 3 years. And then after that, another 2 years as potential follow-on. And then beyond that, nothing at all. So timing is a big component. What if you have two companies coming back to you and asking for a follow-on? Maybe in another world, you would have invested in both of them. But if you only have cash for one of them, Like, which one are you going to pick? So I think investing in general, whether it's follow on or a new position, is all about like, what are the alternatives? Like, what else could you be doing with the cash? I think for angels and family offices, it could even be a crazier set of opportunities, right? Like, you don't even have to invest in startups. You could invest in a new roof for your house. You could invest in a completely different asset class, like maybe real estate's better now, whatever it may be. So that's the way I look at follow-on. It's less about, oh, is this company good? And, oh, should I reserve X for follow-on positions? But rather, what is the best use of this cash right now when it comes back and when I have it, and opportunities that are out there right now.
Okay, makes sense. It sounds to me like you personally prefer having more shots on goal. Is that accurate?
I do. And maybe this is where actually we should try going to the whiteboard. Let me see if I can pull this up, because I want to actually dig into some concrete numbers. I know that some people might be wondering, like, is this like some fluffy webinar thing? We'll start really easy here. I mean, I think if you just sort of imagine, like, okay, let's have a portfolio company, just making the math easy. We have, we have 5, 6, 7, 8, 9, 10 companies. And then let's say, like, the old adage, 9 out of 10 go to 0. So this 110, like, is your winner. And if, let's say, they return, call it 10x of your money, and let's say that we invested equally in all 10 of these, really, we're just coming back to 1x on the overall portfolio, right? Like, this company is making up for the 9 other losses, and now we're just sort of back to 1x. And for a VC fund, it would be less than 1x because we have fees and all this other stuff. So this is actually not a good return. And I think if we were to set this up more concretely, if, let's say, we invested in this 10th company at, I don't know, 5 million post-money valuation, what we're saying here is, assuming no dilution, they sell to Google for 50 million bucks. This is not a good exit. And that is a really hard thing to wrap your head around, because for the founder, it's a great exit. I would say that selling your company to Google for 50 million bucks, in most cases, when you haven't raised a lot of money, is a phenomenal life-changing event if you're the founder. But as an investor, as you can see here, it doesn't move the needle on the portfolio. In fact, it only gets us back to where we started. And this is why it's actually really hard to run a VC firm, because what we're saying here is this fund is predicated on just how big this one winner is. Now, let's say that this winner actually does 20x. At 20x, what we're talking about here is we invest at 5 million post money, assume no dilution for a moment, company sells to Google for $100 million. Even better. But the problem here is now the overall portfolio is about 2x. And after fees and all, it's less than 2x. So 2x, by the way, is what you'll get in the stock market. You invest today, a decade later, your portfolio, your index fund portfolio will be 2x with way less risk. So as a comparison, I think most people would prefer to invest in an index fund than what we see here in this risky startup business. So again, like, this just gets crazier yet. Founder sells a company for $100 million, and we're talking about how this overall fund for the investor is, like, not as good as the stock market. So now I think, like, realistically, what does this number have to be? I think I just sort of say, loosely speaking, it's 100x. And if 100x from start to exit, and then if you account for, let's say, 50% dilution, it comes down to about, 50x on the net. So in other words, what we're talking about here is invest in a company of 5 million post, they exit to Google for $500 million, which is a lot. And then after dilution and all, like, we're getting returned 50x or so to make the overall portfolio 5x gross. And then after fees and all, it'll be, 4x, maybe even a little less net on the whole fund. So I think just, like, take a moment and let that sink in. This is where I think VCs and founders kind of diverge in interest, in that founders, it's a life-changing event, kind of almost no matter what exit you have, especially if you haven't raised very much money. But for investors, it's not. And that's actually why, you see all this arrogance with VCs, like, oh, this is not big enough, this is not a big enough TAM, or whatever it is people say. It comes back to these numbers. So that's probably the easiest starting point. I'll pause there to see if anybody has any questions while we erase this board.
We have lots of questions. Not
Okay.
this exact thing, but there's still lots of questions. I think we should dig into some of them. But one thing I want to ask about that topic, Elizabeth, is that's when you're a VC. What about if you're an angel or family office? How do you think about then returns on and portfolio construction?
Well, for angels and family offices, because it's your own money, frankly speaking, you can do literally whatever you want. You're not answering to external investors. So even if your overall investment portfolio within startups, let's say, is, I don't know, 1x or 1.5x, like, I don't think anyone would say that's great financially, but maybe that's not why you're doing this. I know there are a lot of angels, for example, who want to make a dent in the world in other ways. And some of the companies you may be investing in, I don't know, it could be this like new health company that, maybe you don't think is 100x, but is important for the world to see. So there are plenty of reasons why you might invest that have nothing to do with monetary return. And that's okay if you're an angel or a family office. I think for VCs, like, most of the VCs out there are mandated with basically trying to make their investors the most money that they can. So, there's certainly, I think, differences in that regard.
Yep, makes sense. Okay, Andres has a really good question, I think, around exit timeframes. Should I diversify in terms of exit timeframes? Say, invest in startups with lower exit multiples and earlier exits, mixed with other investments, potential larger exits and longer timeframes?
Yeah, great question. I think this is an important one, especially for angels and family offices, less so for VCs, because VCs invest on a certain timeline that's pretty strict, and you raise money every 3 years or whatever on this timeline, et cetera. But if you're managing your own personal money, there's this issue of, well, I'm going to run out of cash if I only invest in early stage startups, because I'm going to have to wait for my winners to return cash in 10 or 15 years, like the big money, right? You might get 1x's back or partial, wind downs and cash coming back in the first couple of years or something like that, but it's not loads of cash to then reinvest. So I think my personal answer is yes, that I would probably have, if that is a concern for you, where it's like, well, I have this limited budget and I don't want this budget to be stuck for the next 10 to 15 years, then that is where I would try to diversify across kind of all stages. I think tying this back to deal flow, though, it is really important for you to have access to some of that great late stage investing opportunities then, because again, that's where there tend to be a lot of sharp elbows and it is hard to get in. So if you don't have an in to, let's say, a great company, you don't want to just be investing in adverse selection at, Series C or something like that. Because there certainly is still adverse selection even at the late stages, right? Everyone's always trying to raise money, even if they're not a great company. So that is the only sort of concern that I would have, in which case you need to, more than I would say a pre-seed, get yourself in the circles of people who would be seeing, quote, the best deals at the latest stages, like the super fast growing ones. And again, it's because it's so clear who is really breaking out.
Sure, it makes sense. You have more data points.
Right.
How do you think about valuation in terms of portfolio construction?
Yeah, so let's talk a little bit about that here. I think the way I think about all of this at Hustle Fund is slightly different from how other VCs do. And so we'll talk about how other VCs, think about things. I think about things in terms of multiples. So what I just described here on the whiteboard is, at Hustle Fund, every check that we write, we're looking for 100x. So this kind of also ties back to the follow-on question. We have to believe that if we're writing a follow-on check, even though we have more information, it's generally at a higher valuation. And now can we still make the multiple opportunities work? And sometimes the answer is no. Like during a frothy year like 2021, where some companies, we're certainly great, but let's say raising at, I don't know, 100 million post-money valuation, it's just really hard to kind of justify writing a follow-on check into a company at that stage. So that's kind of how we think about things. We think about it in terms of multiples on our money, but a lot of VCs think about things in terms of ownership. So I think ownership and multiples are honestly two sides of the same coin. But investors at let's say a concentrated portfolio might think about things in terms of, all right, we're going to have, again, a concentrated portfolio might be like 10 companies. So 8, 9, 10. And then, for each of these companies, you might say, well, I'm aiming for, let's say, I don't know, 10% ownership. And so when you think about it from this perspective, then now you're not putting the same amount of money into each company. Now you're thinking about it from, all right, ownership is consistent across each company rather than dollar amount is consistent across each company. So this is a slightly different example than the last one that I showed you. So in this case, let's say that on your 10th company, you're investing, I don't know, again, like 5 million post money. What we're saying here is you are trying to then put in $500,000 to get to your 10% ownership target. And then, like, let's say that this company ends up being worth, I don't know, $200 million. Let's say it takes no dilution for easy math. And so 10% of that is $20 million. So that's just kind of how people see things. And then if this overall fund, was roughly, I don't know, like call it roughly a $5 million fund, even though each of these, may have slightly different numbers in them. If it's an overall $5 million fund, you more or less have a 4x on this total fund. So it's a slightly different way to compute it, but it ends up being the same thing. And so I think what I'm saying here is, this is how most traditional VCs with a concentrated portfolio think about things. They vary their check size based on the ownership they can get in. And so they think less about the valuation and more about, am I still able to make my check size work to kind of get that ownership target? Is there enough space for 10% allocation, et cetera? Like, it's more about allocation than anything. And as such, then there are different expectations around each of the companies, rather than, for me, it's like, oh, I expect every company to hopefully do 100x if everything goes well.
So that's for funds, because funds are looking for that 100x because the financials just have to work out. For angels, somebody asked this, for angels investing 1K checks, what valuation should they be looking for? Asked if they're typically on safes.
Yeah, great questions. So what I just described here with this example of ownership, that is very much for VCs. I think for most angels, you're not putting in like a $500,000 check to get 10% ownership. So that's where for angels or even family offices, like, I would encourage you to think more like how we do at Hustle Fund, where it's like every check we write, what sort of multiple are we hoping to get? Now, obviously, this is no guarantee. Just because I write a check, it doesn't mean that company is going to get 100x multiple, right? But that's just what I have to believe. Like, if everything goes right, do we think that the comps in the market could support 100x exit at this from this valuation? So to answer the question then more concisely, if you're putting in 1K, while there's no hard and fast rule around what valuation you should get into, at a 5 million post money, now you're imagining, okay, it's got to exit for at least 500 million or more. If you're getting a 10 mil post, now you're talking about $1 billion range, et cetera. And then there's this level of belief of, well, in a non-frothy year, how many companies actually become decacorns or unicorns? Not that many. It's increased over the last few years, even if you exclude the frothy years. But it is way easier to sell a company for hundreds of millions of dollars than to sell a company for over $1 billion. And certainly anything in the tens of billions of dollars is a real rarity. So that's the kind of belief you need to have as an angel, even if you're writing a 1K check. Like, where do we think this could land based on where the valuation is? And if you don't have that belief, honestly, I just wouldn't write the check if you're trying to optimize for returns. Now, of course, there may be many other reasons as an angel why you might write the check anyway, even if you don't believe it could return 100x, but that's just how we think about it.
Okay. So then we've got some questions about other things. Did you want to do anything else on the whiteboard with this, or should we?
No, we can clear.
Okay. Scooter asks, how do you scale value add when your portfolio gets to be as varied as you?
Yeah, sorry, I think it cut out for a moment. How do when your portfolio gets to be as
Varied.
large?
Varied.
Well, I think actually thought number one is the bar in this industry is so low just by not being annoying or a pain in the butt, like that is a value add. I think speed of response, speed of decision, that's also very helpful. And although that's not value add, like those are very welcome in this industry where people tend to drag their feet and ghost. So that's thought number one. Even if you don't feel like you have a relevant skill set to help your founders, just getting out of the way and not being a pain in the butt, like, under most circumstances, is what I would recommend. But then thought number two, if you want to go above and beyond, there's certainly things that you can do to help your portfolios, everything from providing feedback on a deck or their website or trying their app and providing feedback, stuff like that. If you have domain expertise, it could be introductions in your industry, anything like that. There's all kinds of ways that you can do some light help. I would say in general, most investors don't do heavy help. Like, I think it's just also impossible to your point at, a large portfolio or whatnot. So to this question of, well, what if you have varied portfolio companies? I mean, I think there are common things that apply to every company. Fundraising, if you're investing all in software, they all have websites or mobile apps, providing feedback on that. Introductions to investors or other angels, those are all things that all of your portfolio companies probably need.
And if you, what do you typically recommend if somebody doesn't come from like a tech background where they're already doing a lot of things like marketing or product development or user testing and that kind of thing? What if I'm a lawyer or doctor or something?
I think that's fine. Like I said, I think even just at that first level, just speed of response, speed of decision, especially if you're writing a 1K check, you should be able to make a decision quite quickly. You shouldn't be taking 3 meetings with the founder.
Yeah, right. That's a lot of time from them. Okay, Adam's asking, what attributes have you noticed in your successful founders compared to the ones who didn't do as well? And also and for founders with little field experience?
I don't know what little field experience means, but I think I would say, loosely speaking, our most successful portfolio companies have 2 things going for them. Obviously, there's so many more things that are important, but if I had to pick out the 2 most important things, they would be team and market pull / product market fit. So on the team side of things, our founders who tend to do well, they tend to have high speed of throughput and execution. And this makes sense, right? Because I think the faster that you can iterate on something, the more shots on goal you have. I think fundamentally one of the issues with startups is nobody really knows what the right path is. So you have to test it, figure out if that's the right path. If you're not on the right path, you have to test something else. And so the more that you can do in a set period of time, your runway basically, like the increased likelihood of success. So speed of execution is one. Focus on what is most important. Like often I see founders going off and, trying to do 100 things. And there are 100 things you could be doing as a founder. But generally speaking, for most startups, the most important thing to figure out is like, who is your customer? Why do they buy? And how do I get more of them? That's kind of it. And so everything else is kind of a nice to have. And then I think the third thing is around learning new skills. And as you grow, being able to build a team around that. And so many people start out, at least the founders we tend to invest in, they may not have had any management experience. So there's a learning curve in going from individual contributor to now I'm a manager. Now I'm a manager of 20 people. Now I'm a manager of this like 100-person plus team, et cetera. And I think learning new skills along the way quickly is really important. So that's on the team side. That being said, I've backed many founders whom I thought are great at all of those things, but at the end of the day, there's a lot of luck in whether you actually stumble upon a true market opportunity or not. I think there is something to be said about how these great founders can pivot into something that is an opportunity. So maybe the initial thing wasn't an opportunity, but then ended up pivoting into something that was. And I would say that's true. Founders can do that, and great founders, who iterate quickly can probably do that better. But there is still luck as to whether you find an opportunity and a big opportunity.
Yep. I would also say coachability is something that we value at Hustle Fund.
Yeah, I think coachability is really important. It's a double-edged sword. And I think when people say coachability, they often think, oh, the founder will do everything you tell them to. That's not what coachability is at all. Coachability is people who are willing to hear feedback, process it, and then make a decision on it. So maybe they don't take our advice, and that's fine. But are they willing to hear feedback? I think the other side of the coin is defensiveness or overly stubbornness. And this is important because you get feedback from all angles, particularly your customers, but also other investors if you're trying to raise more money, et cetera.
All right. Going back to portfolio construction for a moment. Let's say that I'm your friend from Twitter who just plunked all my money into the one company. And we've talked about, this concept of investing in 5 to 10 companies over the course of the year. And I know from personal conversations with you, we've talked about small checks, right, to get started so that we can grow without our portfolio without going totally broke. It's April. So what if I do that? If I plunk all my money into this one company, what am I doing for the next, 8 months? Am I just like twiddling my thumbs and then starting in January, I'm going to start looking at deals again? Like, what do you recommend this person do now?
Yes, I would say that's an unfortunate situation to be in. And this is why I don't recommend doing that. I mean, I think pacing is really important. I think also pacing throughout market conditions is really important because valuations tend to go up and down. And like everything else in investing, I wouldn't try to time the market, just like continuing to invest and reinvest continuously if you can. So I think for somebody just starting out, relatively low budget, $1,000 into a deal, maybe try to do a handful of deals this year. So basically you're doing a deal like once every couple of months. So that's also your bar, right? Like all the things that you're seeing in these next 2 months, like what is kind of the best. And it's also okay if you don't see anything that you think is great. Like for us at Hustle Fund, not every month is the same. I think in January we did maybe 4 deals, but in March we did something like 12. So that's why I'd say it averages out to 7 overall, but it's definitely not anywhere near 7 every single month.
Okay. But okay, so then let's put a different hypothetical out there. Let's say I've invested my 10K or so into startups over the course of the year, and then I see a company that like just looks amazing. They're hitting all of the pillars. What then?
Yeah, I mean, I think depending on your financial circumstances, if you were absolutely out of budget, then you're absolutely out of budget, right? It's a budget. But if for you 10K, let's say across the year is a target and you see, like the 11th company that you want to put 1K into, and you're like, yes, that fits into my personal finances, then I would say do it, because it's not gonna be perfect cadence. So, you may end up not doing a deal for 3 months next year.
Yeah, fair enough. Johan is asking, I know we talked a little bit about deal flow and syndicates and the power of syndicates. Also thinking about it from a VC standpoint, what strategies do you recommend using to enrich the pipeline?
Oh, well, if you really want to get into this, I would actually start marketing yourself, whether you're an angel or a VC. Certainly all VCs should be doing this. And this is actually why we spend so much time on Twitter. Frankly speaking, like I think just trying to stay top of mind, and not just top of mind of like, hey, look at me, but also what is the knowledge that we know? What does our network kind of look like? What do we believe in? Like, what are our values? Like all that stuff, like just in helping other people get to know us. So we spend a lot of time on that at Hustle Fund. I truly believe in this world where there are thousands of VCs now. As a VC, you need to do that. It doesn't have to be in the same way that we do it. If you're a specialty fund, it could be around touting your knowledge in a particular domain. So that way people think, oh yeah, I have this kind of business, I'm going to that person.
Sure. Do you think Twitter is the best channel for that as of right now, on social media?
For us, we certainly have seen it in our data. Like a couple of years ago, we saw that over half of our applications were coming in through Twitter. Like people had maybe a couple of other touch points with us, but read a lot of our tweets and knew that they wanted to work with us. But I think there are plenty of great channels that you can try. It could be LinkedIn, it could be TikTok even, it could be YouTube, whatever it is. Some people write great newsletters. You know, Packy McCormick writes a newsletter and he also has a fund. So stuff like that.
Okay. What do you, how do you think about geography as it relates to portfolio construction and diversifying your portfolio?
Yeah, great question. So I think I also have a controversial take on this. I think in many ways, geography doesn't matter. And many LPs and other GPs would disagree with me on that because they're like, oh my gosh, there's emerging market risk and all this other stuff. I actually think the number one risk for startups is not finding product market fit. A lot of people try to explain like why something failed because this happened or that regulatory happened or that whatever happened. Usually it's because they don't have product market fit, and that's just the excuse. Just in having seen a deeper look into many of these companies who haven't made it and have said that they failed for XYZ reasons, just internally I'm thinking it's because they actually just didn't have something that customers wanted. So I think as such, we are willing to take emerging market risk because I actually don't see those companies as that much riskier than, let's say, companies in the US. There are certainly other things that are harder that get built into the valuation, such as fundraising. Like it is much harder for companies in emerging markets to fundraise, and that should be reflected in the valuation. But I think the opportunity set in emerging markets tends to be just as good, if not better, than the US because the US is super crowded.
Any specific industries that you think is better to look outside of the US?
It really depends a lot on country. We've done a lot in fintech in many countries in emerging markets, because I think when you think about how the world is built, first you need a fintech layer. Like if everyone's running around with like literally bags of money, then it's really hard to digitize anything. So you got to get that set first. And then after that, consumer startups can be built on top of that. And then after that, you can have B2B companies who generally sell to consumer startups. I think if you try to build a B2B company when it's too early, then you're selling to the old stodgy industries who take too long to buy, and then your business, crumbles. But if you look in the US, like B2B SaaS really took off after there were a lot of consumer companies because they all sell to startups. Slack, they sell to startups. Like HubSpot, they sell to startups. They all just sell to startups. And then, so that's what allows B2B to thrive. So that's kind of the order of operations I generally see things for various markets.
Yep, makes sense. Francesca has asked, what do you consider perfect size of a venture fund portfolio, assuming 5 years investing, 5 years harvesting, so 10-year fund?
Wow. I think it depends on the size of the fund. Your fund size is your strategy, and also depends on like how good the manager is at picking. I think for a concentrated portfolio, for your quote average portfolio fund manager who has good deal flow, probably 30 companies, I would say. And then depending on the size of your fund. So, just like, I would probably do the checks all evenly. That's kind of my thinking around that. But if you are a newer fund manager and you haven't seen a lot, I would definitely increase from there. Maybe you have closer to 50 or 60 portfolio companies.
Those are the exact numbers that person threw out there, but I wanted to see if you were going to be like in line with that or if it was wildly off, and sounds like you were right on. Okay, I know it's 11:59 here, so we're just about out of time, but Teha did ask, what are your thoughts on the health tech industry? And I'm curious about that too. Do you have a minute to answer?
Sure. We've done a lot of investing in health at Hustle Fund. It is one of our most successful segments. So I think it's the closest to becoming a doctor that my mom wanted me to become. But, I think there are a lot of opportunities both here in the US and abroad. We've started doing some health tech investing abroad as well. Just in general, healthcare is kind of broken and old fashioned. So I think there is a lot of opportunity. I don't know if that's too generic of an answer, but I am very bullish.
Cool. Love it. Okay. Well, I know we're at time. Elizabeth, thank you much for bouncing around on some of these topics, but also for diving in so much to portfolio construction. This has been super fascinating.
Well, thanks, Kara, and thanks to you all for joining us.
Yeah, this is a blast, and we'll be in touch with the recording soon. Thank you.
Take care.